Hello everyone and welcome to this video series on basic financial model. In this particular video, let us look at what you will be able to create after you are through with all the videos on basic financial modeling. So on your screen, you have a complete financial model and you can see we have the income statement. On this sheet, you can see we have the historical income statement and we also have the projected income statement. And below it you will see we have the historical analysis, and based on historical analysis we have taken certain assumptions. So this is income statement. What we are doing here, we are forecasting each item of the income statement. Let's say sales, COGS, SG&A, stock based compensation, depreciation, amortization, interest expense, everything we are forecasting. Reserves, common dividend, preference dividend, and we are forecasting shares, we are calculating basic and diluted EPS, right? And in the next sheet we have balance sheet. We have historical balance sheet for last 3 years and we also have the projected balance sheet. So in this particular model you will be able to understand how to forecast each item of the balance sheet, also how to do the historical analysis, how to take assumptions for each item, right? And then we have the cash flow statement. We have a basic depreciation schedule. First we will understand how to create this very basic depreciation schedule, and then we will also understand how to create this waterfall depreciation schedule. Okay, here if you see we have calculated or we have prepared depreciation schedule based on two methods, SLN and WDV. You just need to change the input from here. If you want to calculate depreciation based on straight line method, then type 1, and depreciation will be calculated based on SLN method. If you change it to 2, then it will be calculated based on weighted out method, right? If the life of the asset is 6, then type 6. If you have, let's suppose, 5, then make it 5. Then depreciation will be applied for next 5 years only. So if you make it 2, then depreciation will apply for next 2 years. So this is so dynamic. Now let's come to the next sheet. On the next sheet we have this basic debt schedule. First we will understand or we will lay down the foundation of debt schedule with basic example, and then going forward we will understand how to create a very dynamic debt schedule also, right? So on this particular sheet we are going to forecast short term and long term debt, and we will also forecast interest on short term and long term debt, right? So there is a concept behind it. How do we prepare this debt schedule? We first have to forecast how much cash flow the company has, how much cash flow the company will be able to generate. Based on those cash flows only we will be able to prepare our debt schedule. If the company has sufficient cash available with the company, then it can repay debt, or if it has negative cash balance, then to finance that negative cash balance it has to go for short term or long term debt, right? We will have a lot of discussion about these concepts when we actually make this schedule. After this basic debt schedule we will go and proceed with the advanced debt schedule also. This debt schedule will be little difficult to understand, but you should watch the video multiple times to understand the concept, and if you face any problem you have the option to connect with the institute. Now here if you see, these are the long-term funds required, right? So you can divide this requirement of funds into debt and equity. So if I, let's suppose, change to 30% debt, then 70% funds will come from issuing additional equity. So whatever funds will be required, the repayment will be done here. So long term debt, you can change the life here. Let's suppose from 5 to 2 years, the debt will be paid in 2 years. If you make it, let's suppose, 4 year, the debt will be paid in next 4 years. If you change it to 6 year, debt will be paid in next 6 years. It is so dynamic. To prepare this particular debt schedule, you have to perform so many calculations here. Like you have to calculate sources of cash and application of cash, how much cash reserve you have, and various other things. So we will be able to create the schedule after watching the entire video series. We also have the equity schedule here. We have the working capital schedule, wherein you will be able to forecast account receivable, inventory, accounts payable, accrued liabilities, and other things. You have to understand the projection criteria, how to forecast each item of income statement, balance sheet and cash flow statement. And at last we will also create a scenario, right? This scenario, as of now I have created this scenario only for sales, but you have the option to create schedule for all the items of income statement and balance sheet. I have created scenario only for revenue as of now, but I'll teach you how to create schedule for multiple items. Like in this case, in the best case scenario, sales will grow at 10%, sales will grow at 8% if the company performs on an average. If the company performs weak, then the growth rate of the sales will be 6% only. This is what we have assumed for this model. You have the option to change your assumption according to the company, according to your business analysis. So if you come to the income statement, right now the company is growing at a 6% growth rate. If you want to change this, then you have to change the scenario here from weak to best. Just look at this. If you change the scenario from weak to best, automatically your forecast will update. Let me change from best to average this time. Income statement will update. If you change this to weak, then this is how the company will perform. So if you change anything in your assumptions, then entire model will automatically update, because this is a complete financial model and it is an integrated financial model. If you change something from anywhere in the model, other things which are connected with that will automatically update. By the end of this video series, you will have proper understanding of how to create an integrated Excel based financial statement model. You will forecast income statement, balance sheet, cash flow statement. For sure, you will have good understanding on how to use Excel. You will have good understanding on the format of income, balance sheet and cash flow, how financial statements are connected with each other. And going forward, this particular knowledge will be very helpful when you will create sector specific financial model. Sector specific financial models like oil and gas model, auto sector model, real estate model, telecom model or FMCG model. There are various other models also like LBO model. If you have proper understanding on how do we prepare financial model, then creating those advanced financial model will not be a difficult task. And then also you have to understand how to perform the valuation. The knowledge of financial model will also help you in doing the company valuation with DCF, trading comps, transaction comps, because in that what you have to do, you have to collect the data from the company filings. So when you will be taking the data from company filings, this particular knowledge will help you there also. And obviously in merger and acquisition also you need to have the knowledge of financial statement, because in merger and acquisition what you are doing, you are going to combine income statement of the target and the acquirer, and you will be looking at the pre-merger and post-merger scenarios. You will be looking at the changes in the balance sheet and income statement after merger and pre-merger, and you will do the analysis on that. So this knowledge is going to help you everywhere, even in your job. So I'm sure that you have understood what we are going to learn through this video series. So this particular model we will create at the end of 20 videos. So I'll see you in the next video. Thanks for watching.